Second quarter 2026 Charter Communications results are officially out. Revenue is sitting at $13.5 billion, which is down 1.7% year over year.
Right.
Basic earnings per share came in at 10.76, and that's up from 9.41 last year. Net income held steady at $1.29 billion. And, well, crucial for this entire long-term investment thesis, full-year CapEx guidance is being held firm at a massive $11.4 billion.
Yeah, those are the really heavy-hitting headline numbers flashing across trading terminals right now.
Exactly.
You look at it, and the top line looks completely stagnant. The bottom line looks, mildly improved, but the spending is just astronomical.
It is, yeah. But today's deep dive is a pure, concise financial analyst recap of what is actually driving those numbers. So our mission today is to unpack the underlying segment performance, those shifting margins, and management's commentary. We really want to show you, the retail investor, what is actually happening beneath those top-line figures.
Because, a 1.7% revenue decline really doesn't tell the whole story, does it?
No, not at all.
Right. In a world of just total information overload, cutting through the noise of a telecom earnings report this dense, it requires looking way past the surface. You have to look at the structural shifts happening inside the business model itself.
Definitely.
So the goal today is to map out where the cash is being generated right now versus, where management is aggressively placing their chips for tomorrow.
And to do that, we're going to move straight from that top-line revenue decline directly into the segment details that caused it.
Yeah, let's get into it.
Because beneath that 1.7% drop, there is this really fierce tug-of-war happening between Charter's legacy internet product and their newer mobile growth. So let's look at the mess first. Internet customers declined by 172,000 in the second quarter.
Wow.
Yeah, it's a big hit. They are now sitting at 29.4 million total internet customers. And the revenue attached to that specific segment dropped 3.2%, down to $5.8 billion.
Which is painful. And management attributes that loss directly to a highly competitive environment.
Right, the fiber guys.
Exactly. Charter is facing intense pressure on that core broadband product, mostly from those fiber competitors just creaking into their territories.
Yeah.
But, if you flip over to the other side of the ledger, you see this massive beat that offset a lot of that pain. Mobile is just the undisputed star performer of this quarter.
No, absolutely.
Charter added 406,000 mobile lines in just 3 months. That brings their total up to 12.5 million mobile lines. And the revenue surge there is significant. Mobile service revenue shot up 18.9% to $1.1 billion.
Okay, let's unpack this, because to a lot of retail investors, this dynamic looks exactly like a leaky bucket.
A leaky bucket.
Right.
Yeah.
Like, if Charter is bleeding their traditional high-margin broadband subscribers to the tune of 172,000 people leaving, but gaining 406,000 mobile lines, are they actually growing the business?
That's the big question.
Or are they just cannibalizing their own customer base? I look at this and I wonder if they are just shifting revenue from a highly profitable wireline pocket into like a lower margin wireless pocket just to keep the lights on.
Yeah, and to understand why it's not quite that simple, we have to look at the mechanics of their convergence strategy.
Okay.
Because you cannot look at Charter's mobile product as a standalone wireless company. It is deeply, deeply integrated into their physical wireline network.
How so?
Well, management dropped this incredible metric in the report. They said 87% of all Spectrum Mobile customer data is offloaded onto Charter's own Wi-Fi network.
Okay, wait. I want to pause on that 87% because for anyone who understands how an MVNO, a mobile virtual network operator, works, that number is basically the holy grail.
It really is.
Like normally when a cable company offers mobile service, they don't own the cell towers, right? They just rent space on someone else's network, like a Verizon or an AT&T, and they have to pay wholesale rates for literally every gigabyte of data their customers use.
Yep.
So it is notoriously difficult to make a strong profit margin doing that.
Which is exactly why that 87% offload is so vital. Charter isn't paying those third-party wholesale rates for the vast majority of the data their mobile customers consume.
Because they're on Wi-Fi.
Exactly. Instead, that data is hitting their own 45 million national wireless access points. It is traveling over their 1.1 million network miles of physical cable. So mobile isn't just, a separate product line trying to carve out market share.
Right.
It's essentially a retention mechanism for the core broadband network, but it's disguised as a growth engine.
So they're essentially turning their customers' home and business Wi-Fi routers into mini cell towers just to bypass the major wireless carriers entirely.
That's exactly it.
And it's designed to lock you into their ecosystem. You bundle the home internet and the mobile service, you get a highly competitive data plan, and suddenly, you're much less likely to churn out and switch to a fiber competitor.
Right, because you'd have to untangle your entire digital life to leave.
Exactly.
And that transition to bundling services brings up the next major structural shift in this earnings report. Because if the core broadband product is bleeding customers, we have to look at how the notoriously difficult legacy video segment is holding up.
Oh man, the video segment.
Right. Historically, the traditional cable TV bundle has been the ultimate leaky bucket for, the last decade?
Yeah, easily. And the video numbers this quarter are so fascinating because they send completely mixed signals.
Yeah, they do.
So on one hand, video revenue dropped 9.7% year over year, landing at $3.1 billion.
Yeah.
But the underlying customer metrics tell a totally different story.
Right, the actual losses.
Exactly.
Yeah.
The actual customer losses improved dramatically.
Yeah.
Charter only lost 21,000 video customers this quarter. And you compare that to the second quarter of 2025, where they just hemorrhaged 80,000 video customers.
It's a huge difference.
So the revenue is down heavily, but the subscriber bleed has been aggressively bandaged.
Yeah, and the why behind that bandage is what management is calling their seamless entertainment strategy.
Seamless entertainment.
Right. Charter is actively resurrecting the old cable bundle, but they are adapting it for the modern streaming era. So they're taking their TV Select Plus packages and they're including premium program or streaming applications at literally no additional cost to the consumer.
Wow.
We're talking about baking in ad-supported or standard versions of, Disney Plus, Paramount Plus, Max, Peacock, AMC Plus, Discovery Plus, and ESPN Plus, all included.
Right, and according to the earnings presentation, this creates about $127 a month in retail streaming value for the customer.
It's massive.
And they deliver it all through this unified, frictionless video experience using the Xumo Stream Box and the Spectrum App Store. But, looking at the financials, I just have to ask you, is this just the old cable bundle wearing a new streaming trench coat?
Financially speaking, it absolutely is.
Yeah.
But the mechanics of how this actually impacts the income statement are so critical for investors to understand, because this strategy is far from free for Charter.
No, not at all.
This pivot to seamless entertainment cost them $251 million this quarter.
Ouch.
Yeah, that is money specifically allocated to those programmer streaming applications. And accounting rules dictate that this cost is netted directly against their video revenue.
And that $251 million is up from just $67 million in the prior year period.
Right.
That is a massive spike in what they are paying out to Hollywood and to the tech streamers, basically just to keep a Charter cable box in your living room.
Exactly. And that massive increase in cost allocation is acting like a really heavy anchor on their average residential monthly revenue per user.
The ARPU, yeah.
ARPU dropped to $117.52 this quarter. And just to put that in perspective, management noted that if you actually exclude those streaming application costs, residential revenue would have only declined 1.8% instead of the 3.5% they reported.
That's a huge delta.
It really shows a deliberate financial trade-off. Charter is intentionally sacrificing top-line video revenue and ARPU just to buy customer retention.
They're essentially subsidizing your Max and Disney Plus subscriptions to stop you from cutting the cord.
Yep.
And based on that dramatic improvement in video customer losses, dropping from 80,000 defections down to just 21,000, the strategy is actually working. It's slowing the bleed.
It is.
But paying a premium to keep you in the ecosystem naturally forces us to look at the bottom line. So let's connect the cost of these operational pivots, the expensive streaming bundling, the mobile integration directly to the company's margins and their capital expenditures.
Because the margin compression is very visible here. Adjusted EBITDA, so earnings before interest, taxes, depreciation, and amortization, is down 4.3% year over year to $5.4 billion.
Right.
And even if you exclude the transition expenses from integrating Cox Communications, it's still down 3.2%. And while earnings are dipping, their capital expenditures remain incredibly heavy. Charter spent $2.9 billion on CapEx just in this second quarter alone.
That's just wild. For the listener trying to visualize where $2.9 billion actually goes in 90 days, there are really two main buckets, right? First is rural build-outs. Charter is aggressively expanding their physical footprint into unserved and underserved areas, and that's heavily subsidized by government broadband programs.
Yeah, that's a big piece.
The report notes they activated 127,000 subsidized rural passings this quarter. And just for those unfamiliar with telecom, jargon. A passing is simply a home or business that the physical cable now runs past, meaning that address can now theoretically sign up for service.
Exactly.
So activating those 127,000 passings directly led to 47,000 actual new customer relationships in those areas.
Right. And then the second massive bucket of spending is what management calls network evolution.
Right.
They are upgrading their existing, legacy infrastructure to deliver symmetrical multi-gigabit internet speeds across their entire footprint.
Symmetrical meaning upload and download are the same.
Exactly. Upload speeds match download speeds, which is a direct defensive maneuver against those fiber competitors who use symmetrical speeds as their primary selling point.
Okay, so what does this all mean for the shareholder right now? Because looking at a company guiding for $11.4 billion in CapEx for the full year 2026, while their EBITDA is actively declining, well, that sounds terrifying for retail investors.
Yeah, definitely can.
We also saw Q2 free cash flow come in at $969 million, which is down $77 million year over year. That is a staggering amount of cash going out the door to build new physical networks, while the core internet subscriber count is actively shrinking.
Well, to reconcile that fear, you really have to look at management's multi-year outlook slide. I mean, this is arguably the crux of the entire Charter investment thesis right now.
Oh, so?
Management is basically telling the market, look, yes, we are spending $11.4 billion this year, and yes, it hurts, but they are promising that CapEx has peaked. They are modeling a really sharp decline down to between $7.5 and $8.0 billion by 2029.
See, I have to push back on that a bit, though.
Okay.
Management teams love to promise a land of milk and honey 3 years down the road. But trusting a 3-year cash flow promise in a technology sector that is moving this fast, it feels incredibly risky.
It does.
I mean, what happens if fixed wireless gets significantly better or fiber rollout accelerates and Charter just has to keep spending to compete? They're basically asking investors to hold their breath for a very long time.
And that skepticism is absolutely warranted, I agree. But the logic behind management's bet is rooted entirely in physical infrastructure.
Right.
The strategy is just to endure the heavy lifting, the margin compression, and all the high debt costs right now. You build out the multi-gig network today. You capture the subsidized rural footprint before competitors even lay wire. You lock in the customer with mobile and seamless streaming bundles.
Yeah.
The thesis is that once this current network evolution cycle is complete, the physical moat is built. The maintenance CapEx requirements will just plummet, and management projects that will drive rapid, sustained, free cash flow growth by 2029.
Here's where it gets really interesting, though. Because now that we understand those cash flow dynamics, we have to look at how management is allocating the cash they actually do have today.
Right.
And the existential risks hanging over the balance sheet while we just wait for this 2029 promised land. Charter is juggling a massive debt load, heavy rural network builds, and integrating 2 major acquisitions simultaneously. Yet they are still aggressively buying back their own stock.
It's wild. The capital allocation strategy is incredibly aggressive. During the second quarter, despite that heavy CapEx burden we talked about, Charter bought back 4.0 million shares of Class A common stock for $838 million.
Wow.
Yeah, that averages out to roughly $210 a share.
But they didn't stop at equity, which is the crazy part. They also went into the open market and repurchased their own debt.
Yeah.
The report states they purchased $1.2 billion in aggregate principal amount of their debt, but they bought it for just $1.0 billion in cash, which secures what the financial world calls a gain on extinguishment.
Yeah, and let's break down the mechanics of a gain on extinguishment because it's actually a very clever piece of financial engineering.
Okay, let's hear it.
Imagine you owe someone $100 and you have an IOU out there. Because interest rates have risen or maybe market conditions have changed, the person holding that IOU might be willing to just sell it to get some quick cash. So Charter went out and bought back their own $100 IOUs for just $80. They spent $1.0 billion in real cash to erase $1.2 billion in future obligations. And that $200 million difference gets recorded as a paper profit, a gain on extinguishment.
It's a really smart move, but they are doing it out of necessity because the balance sheet is carrying a monstrous amount of leverage. Total debt sits at $93.8 billion.
Huge number.
Just to put that in perspective, that is like trying to juggle chainsaws on a tightrope while building a new house.
Yeah.
You are servicing almost $94 billion in debt while simultaneously trying to spend $11.4 billion in cash on network upgrades.
Which naturally brings up significant execution risk. I mean, you have the heavy debt and the heavy capex, but you also have massive M&A transition risks currently in play.
Right.
This earnings report specifically calls out transition expenses incurred to prepare for the integration of the Cox Communications transaction.
Wow.
When that deal closes, Charter is assuming another $12.4 billion in outstanding net debt. And on top of that, they are restricted in their day-to-day operations by the pending Liberty Broadband combination.
So looking at their leverage ratio, which is the net debt, compared to their last 12 months of adjusted EBITDA, it currently sits at 4.18 times.
Yeah, and that is undeniably high for this macro environment. Management stated they plan to maintain leverage near the midpoint of their 4.0 to 4.5 times target range leading up to the Liberty Broadband closing.
Okay.
However, post-closing, they are targeting bringing that leverage down to 3.5 times at the Charter operating first lien level.
And let's just clarify first lien level for the retail investor real quick.
Hmm.
If a company ever goes bankrupt, the first lien debt is at the very front of the line to get paid back from the sale of assets.
Right.
It's like the primary mortgage on a house.
Yeah.
Whereas unsecured debt is more like credit card debt.
Yeah.
Management is prioritizing bringing that senior secured debt down to a safer 3.5 times ratio. But synthesizing all of this, I mean, it just feels like an incredibly precarious balancing act.
It is a high-wire act of financial engineering, without a doubt. Management is betting the entire farm on the sheer scale of their physical assets.
Yeah.
They own 1.1 million network miles. They have 59 million passings across 41 states. They fundamentally believe those physical in-the-ground assets guarantee long-term market dominance.
Makes sense.
So they are willing to utilize heavy debt, endure short-term cash flow hits, and aggressively repurchase undervalued shares right now, all to cement a monopoly-like grip on the converged future of connectivity.
Right. So to sum up this earnings recap, Charter Communications is actively trading short-term profitability and accepting legacy broadband subscriber losses today in exchange for long-term seamless connectivity retention and massive future free cash flow promises. They are spending the money now to build an impenetrable moat.
And that moat is entirely built on owning the base layer infrastructure that all these disparate services, the streaming apps, the mobile phones, the smart homes, rely upon to function.
Which leaves us with a final thought for you to mull over. When you look at a company with 1.1 million physical network miles, symmetrical multi-gig upgrades rolling out everywhere, and a staggering 87% of their mobile customers' data offloading directly onto their own private Wi-Fi access points, is Charter even a traditional cable company anymore?
That's the real question.
Or are they quietly utilizing their massive broadband footprint to become the country's largest invisible wireless carrier? Well, if you want to stay ahead of the curve and understand the structural shifts driving the markets, hit that follow button for our daily earnings coverage.